All right, good morning, everybody. Hope everybody that's in the Buffalo area, whether you're in the North Towns or the South Towns, that you survived the first little bout of winter with our lake effect. So we are hardy Buffalonians, so just little 48-inch dusting is nothing to be concerned about. We can handle that very well. So a couple administrative things. Everybody should have that returned their midterms. Should have received the results there with the attachment concerning positions for work. Everybody did very well. Tried to just summarize the little things. Sometimes there was an error made, and it's one of those things that just kind of keeps on going right down the entire return. So I try not to dock too many points when somebody has one of those errors like that, something they may have forgot to do early in the return, especially maybe in the income section. And, it doesn't necessarily mean because the refund was not right on the answer. So that I'm going to take off all the points for anything after that. So I try to grade them that way. Okay. Speaking of exams, our final exam is coming up a little over a week. I realize that some of you are not in locales that you can come in, but I'm going to send out some time frames at the beginning of the week regarding when you can come in. I'd like to meet you in person, and typically we try to have everybody come in to do the final exam if at all possible. If not, we'll try to make alternative plans. Okay. As you can see from our class syllabus, we're basically down to our last couple classes online, okay? Today we're going to do rental income and healthcare. 2 chapters seems like a lot of material, but not too bad. We'll try to summarize those best we can. And then next Saturday, what we're going to do is the last 2 chapters, 17 and 18, a lot of reading, but it'll be a very short lecture time. We're going to spend the other half of the time kind of as an open review for the final and kind of a review of the class. So between now and next Saturday's lecture, if you want to take time to make notes on questions that you have for anything that we've covered, anything you'd like me to review. I know we had one question today regarding the quiz that I'm going to go over, but so that we'll definitely take that next Saturday to be able to spend time to do a review session. Kind of touch, like I said, we're going to use it to going to try to have some of the notes for different states. I know we're not all New Yorkers here on the class, so that try to do some things where I'll show some of the little things that how the state returns work with the federal when you're in another state, or even living in 2 states, or non-resident income, things like that. So that's kind of what we'll do. Like I said, the chapter 17 and 18 from my in-class lecture time does not take long to go through. So we'll kind of have that. All right. Start off, somebody had a question about, let me grab a copy of it here. I think it's up on the screen, but we had a copy of the question about a question in chapter 14's quiz. It was let's see, let me just double check here. Was problem 17 on page 1450 in your textbook. And it was regarding some of the things from Business Income Part 2. It was regarding the ones about the quiz, about 17. The question is, list the forms to file the following transactions. Then write the line of Form 1040 where the results would be entered for each type of business gain or loss. Okay. The first one is Form Schedule C is used to file a sole proprietorship with a net income of $10,000. Remember, our Schedule CEZ is limited. As I told you in the instructions when I kind of talked to you about doing business income, I like everybody to use the Schedule C. It can be determined that if they meet the criteria at the top of the little flow chart and criteria to file on a Schedule EZ, that they can use that, but try to use the Schedule C. It transfers over to line 12 on the 1040. Okay. The form Schedule CEZ is used to file sole proprietorship with a net income of $1,500. What the intent of these two questions was is to kind of show that if somebody has a higher income sole proprietorship, higher expenses, so that their net income is like $10,000, that's definitely a Schedule C. If it's a little smaller business with a lot less income and expenses that don't create a loss, then you're on the Schedule CEZ. Okay? Again, C, CEZ, both go to line 12. And then the last question is a Form 1065 is to do a partnership. All right? And that comes over to line 17. We'll talk a little bit about that today. All right? And the federal employee identification number is the number given to business because they pay employees. Anybody that has payroll or anything like that, they have to get one of those EIN numbers. It's basically like a social security number for the partnership or the business or the C Corp or whatever it may be. So that just has that. Okay. All right. Okay. Any other questions about anything out of the business income? As I said, when we talked about it, just remember that I realize depreciation is a tough thing. I try to simplify it best I can. And, if you really, really, really want to simplify it, basically depreciation is an expense and you got to treat it like a pie. You just decide when you're going to eat the pie. If I'm going to eat the pie all at once, I'm doing a Section 179. If I'm going to eat half the pie and then eat the rest of the pie in the years to come, I'm going to do special allowance. If I'm going to eat a piece of the pie for each year that I can, that pie, that is the regular depreciation. So just treat it like that. Just decide, and you meet with the client and they decide, hey, because I've been hungry and I've made a lot of money, I need to eat that pie at a certain time. And you try to match that up. Okay? So just try to do that best you can with the different depreciation methods. Okay? All right. And, always to kind of review. It's very nice with tax-wise that we have the worksheets that help us with the conventions. I know my in-class, we went through that again last night and yesterday morning, where we had the convention discussion about picking mid-quarter, half-year, mid-month. We're going to talk about rentals today and just realize that those are on mid-month. When you look at things that are in businesses, just depends when it's purchased. If it's purchased before June 1st, you get a half year. If it's after June 1st, you use mid-quarter. Okay? All right. So we're going to get right into Chapter 15. Basically, 15 is going to be an extension of what we did with the business income. Okay? And what I mean by that is that we have now we have income property, and we're going to have income and expenses. Very similar to what we did with the business, where we had income and expenses. The forms, we were on a Schedule C with the business income. With rentals and royalties and things like that, we're going to be on the Schedule E. So really, we're talking about the line that we were referring to in the question. We're going to be on that line 17 and things that are going to flow over to that. Okay? All right. So as we talked about, in this chapter, we're going to determine the makeup of rental income, real estate or personal property. We're going to report rental income and expenses on the tax return using our Schedule E. We'll talk a little bit about royalty income. Don't see a lot of it. We're going to correctly report royalty income on the tax return. Talk very briefly about it. Royalties, really the ones I see most often now with royalties is somebody has royalties due to something on the internet. Best example is somebody has an app. and they've developed an app, and they have that app out there for somebody, and every time that app's used, they get a certain percentage. They get a royalty, okay? All right, so we have rental income. Rental income can be generated from a variety of sources: personal property, service provided to renters, real estate, and for different purposes: for profit, not for profit, okay? If not rented for profit, if your rental income is greater than rental expenses for at least 3 out of 5 consecutive years, the IRS presumes the rental motive is for profit, okay? For rental activities not conducted with profit as a goal, you report it on line 21 under other income, and then your expenses go on Schedule A. So basically, it's kind of like we've talked with the sole proprietor of the business in Schedule C. If we're not trying and are not materially participating and we're not making a profit, then the IRS is going to say, are you really doing this? So that if it's not the case, then you're just going to show the income as other income, taxable, and then the expenses would go on a Schedule A. Okay? All right. We've talked about real estate rental income. You can consider income from rentals, many different forms. Usually everybody thinks of, hey, I have a tenant, I'm a landlord, I receive income, so that's rents paid, okay? It can be advanced rent. It could be where you have somebody living in the property that's doing something, and you give them, you know, basically a free month of rent for the services that they provide. Or you could say that the tenant pays the water bill and deducts that amount from their rent. You know, different things like that, okay? The security deposit, that can be income, okay? All right. But it says there, but if it's kept because the tenant did not live up to the lease terms. So if it's the case that sometimes the lease might be set up that the last month's rent is the deposit, then that's when you would realize that security deposit, okay? Rental expenses. Again, we kind of talked about the fact that this is very similar to what we see in the Schedule C with our business and sole proprietorship. So we have here our rental expenses. We have advertising, you know, right down through supplies. Very, very similar to what you saw in a Schedule C. Form's a little bit different, but again, very similar. Okay. All right. There is a little thing that is there that you have for a safe harbor election. And this is something where we can have something for those that have an expense up to $2,500 per invoice or item, that you can take that as an expense all in 1 year, okay? Typically, we had that rule of thumb where anything that was over $1,000 we depreciated, but in this case, we have a little bit of a get out of jail free so that we can use that way. Kind of helps us with the what is the limit on expenses? 2% of the AGI. That is the expenses when you have it to where you're not for profit, okay? So when we're doing regular Schedule E's, there's no limitation. That one you were seeing there that is subject to the 2% because it would go in that section on your Schedule A where it is limited to the 2%, okay? It talks about here about what falls under the safe harbor. So again, these are things where you can take that. At the bottom of the page there, when you elect to take the safe harbor, there's a little thing that you put in there that you attach to the return that explains, hey, I'm electing to take this as an expense, okay? All right. Did I lose everybody? Okay, do I still have everybody? Okay. I just had a message that somebody tried to log in from a different device. Okay. All right. So I just want to make sure I still had everybody. Okay. All right. Depreciation. Again, we have assets that we have within our rental that we are going to depreciate. Okay. So we want to make sure that we use that. All right. Lot more restrictions as far as the special depreciation in the Section 179. Okay. Rental property itself, not something that's allowed to take that 179. We can't take our new purchase of a duplex and take all the expense in 1 year. We have to depreciate that over its useful life. So things are a little bit different with this. There are some things where we can do special depreciation allowance when we talk about certain things that may qualify for that within the rental property, okay? But when we go through the problems, we'll talk a little bit more about that. As you can see on the little chart here that talks about the makers in the GDS system, most rental property and furnishings fall in that 5-year. So new appliances, carpets, furniture used in rentals, they all fall in that 5-year, okay? Down below, you can see something where it talks about roads, shrubbery, fences, 15 years, okay? So we're going to have those as a 15 years of useful life, okay? And as we see at the bottom, rental property, anything that has to do with the physical building, you know, we talk about roofs, anything like that, you know, furnaces, anything that has become part of the structure that the rental or the income property, we're at 27.5 years, okay? All right. For calculating prior depreciation, we have our chart here. If you remember back in 14, we had those pages where it talked about the conventions and the what table to use. We had referred to tables A1 through A5. This one we're going to be using table A6. Rental property is always going to fall under that mid-month convention for 27.5 years, okay? Yes, roads include driveways, okay? So we put those in there, all right? I guess depending where you live, 15 years for a driveway. In Buffalo sometimes with the salt and the snow that we're experiencing right now, driveways aren't going to make 15 years. Bob, where you're at, good driveway will probably last more than 15 years. So, but they do use the 15 years on that, okay? All right. Okay, we had a question about if I sold my rental on September 18th of this year, which is 3rd year owned, what is the depreciation? Okay, you'd have to calculate that. You'd have to know when you put it in service. And then there's a way that I'll show you later that'll show you how we sell a property, rental property, where we have to recapture depreciation. So we're going to cover that a little bit later. Okay. All right. Talks about changing a property from personal use to rental. Does happen if you have 2 people and they get married and one's primary residence no longer is their primary residence and they turn it into a rental, then we have to handle that a little bit differently. And then we have to figure out also the depreciation when it starts, when it was turned into a rental. Okay. Talks about the personal use of a dwelling unit. Okay, including a vacation home. In the case of any personal use of a dwelling, including a vacation home that is rented, the expenses must be divided between rental use and personal use. It talks about allowable rental expenses will be no more than the total expenses multiplied by a fraction or percentage or whatever you want to call it, okay? This is where somebody would have something that, you know, that they have, you know, a vacation home that they're renting, you know, to somebody else. You know, if it's being used for personal, then you have to make sure that only a certain number of months or percentage of the expenses. You can't take the income for the months that you rented and put it, you know, and then have the expenses. While some of those expenses may be your personal, you have to make sure that you do not, you know, try to, I guess in lack of a better term, double dip on those, okay? Now, if a dwelling is both rented to others and also used as a personal residence, limitations may apply to rental expenses deducted. A dwelling unit is considered to be used as a personal residence if used for personal purposes during the tax year for more than 14 days or 10% of the total days it was rented to others at a fair rental price. So again, you have to make sure that you determine how many months you're using that property, okay? So you have to make sure that you break down the percentages. The other thing that comes in play is, down at the bottom, it talks about if you have a home that you are renting for less than 15 days, it says if a dwelling unit is used as a home and it was rented for less than 15 days during the year, its primary function is not considered to be a rental and should not be on a Schedule E. There is no requirement to report the rental income and rental expenses from this activity, okay? Best example of this is a lot of times with professional golf tournaments, when the professionals come into an area near the golf course, some of them will rent homes for a couple weeks during the tournament. And once they do that, that income to that person basically is not reported, okay? Because if it's their primary residence in their home and they rent it for less than 15 days, there's no reason to report the income. Obviously, you don't get to take the expenses that you incurred during those less than 15 days, but basically you have that money as rent-free. Okay? So those of you that are near golf courses and would like to rent your homes, that's an option. Okay? No, it's not reported as other income. You don't even have to report the income. Okay? All right. Okay. Excuse me. All right. Renting property is obviously at risk, but there are limitations depending on how the calculations and the other things that are on the return. Sometimes if you have that net operating loss, you'll have to carry that over to the next year and the limitations. But again, when we get into the problem that we're going to do, I'll show you that in action a little bit more. It's a hard topic to discuss. You can read here as to how the limitation is described, but it's a little easier to see it in action with the Schedule E when you have that activity there that you're participating in. Okay. Royalties from copyrights, patents, and oil, gas, minerals, things like that. They show up Part 1 of Schedule E. Again, we'll see this in action, but you have a category to select for that. So you'll have royalties there. If anybody has a copyright or a patent or partnership where they have oil and gas mineral rights, a lot of times we'll see from a from a K1, we'll see that income come over to a return on a Schedule E from the partnership return, and that'll be reported on a Schedule E with the K1 as royalties. Okay. All right. Again, like we talked about within the business one, we're pretty much going to be on a cash method. What that means is we cannot deduct uncollected rents because they have never been reported as income. So we have to say when the dollar changes hands. So if I have somebody that has rent for December, but they pay me and the money is actually taken into my account after the first of the year, then it goes into the next tax year. I can't put it back into the month that it's for. I have to have a cash basis. Just as we talked about with the sole proprietorship, joint venture rule applies for married couples. Okay. As you see here, we have a Schedule E. Like I said, I like to do a lot more talking about it when we get into the practice problems because that works a lot better. We can see the different parts of the Schedule E in use. And also there's certain little components of tax-wise I want to make sure that you do when you do a Schedule E so that you don't, so it doesn't create problems also for the year that you're doing the return. And if it's a returning client or a client that will be coming back years to come, there's certain things that are just special little idiosyncrasies, I guess, of the tax-wise that you have to use on the Schedule E. Okay. It has many pages here. And again, you can tell this is right out of the publication for the Schedule E. So it talks about each line and what those expenses are. Again, we talked about the expenses in there. Oops. And you look at them: advertising, auto, it's business miles. We get our 54 cents for 2016. Cleaning and maintenance, commissions, management fees. Some people have rental properties that maybe are in other areas where they have somebody that they pay to kind of be that landlord or overseer to take care of the property. Commonly missed expenses, not typically. Most everybody understands, especially that are landlords and own property. But there are a few things, like I said, sometimes people don't realize those management fees for somebody that's overseeing the property. A lot of times, depreciation is the thing that's missed. People tend to think, okay, I bought the property, I'm going to depreciate it. They forget that if they do that capital improvement where in the tenants, they remodel a bathroom, or they put a new roof on, or the siding, or whatever it may be. Sometimes they forget to take those, and sometimes utilities, especially in a duplex, where maybe there's 1 meter for something and they're not dividing that up. So that's things that you have to kind of keep an eye out. Okay. All right. I have a little homework here that they have you go through, some exercises to kind of see what things are. Okay. All right. So what we're going to do is we'll take just a couple minutes here so I can get myself set up on the computer. If you want to grab your workbook, we're going to actually get into the return that we have on page 197. It's the problem 15-1 for Nancy Jones. She has a return there that we're going to work on and talk about. Things that she has with her house that she lives in and rents, and she has W-2. So if you want to, I'm not sure if you guys want to bring up the problem, but we'll get things situated here, and then we'll get ready to go, and we'll do Nancy Jones on 15-1. So take about 5 minutes if you need to warm up your coffee, since it is a chilly morning here in Buffalo. I again realize some of you are not here, but just take a few minutes, and then we'll go through the problem. Going to discuss a lot more of the things that kind of went over when you see them in action in the Schedule E. Okay, we'll be right back. Okay, so like I said, we're going to be doing out of your workbook for Chapter 15 for the rental income. We're going to be doing 15.1 Nancy Jones. It's on page 197. Went ahead and set her up in there. So I have all my main info sheet and everything completed for her. We're going to kind of talk about her bullet points very briefly here. She filed a tax return. She had a state refund. She did itemize last year, and she had a state refund of $342. She'd like to do any refund or amount owed electronically. I see that she has a W-2G because I see in the bullet point she has some gambling winnings, but has receipts for losses. And she has rental property that she owns, and she lives in half of the house. Okay, so talks about the different things that we have there. Okay, so we have our information about the rental, and we have some tax documents. So we'll go ahead and get those tax documents in there. All right, we have the tax documents on pages, let's see here, it looks like page 199 through 201. We're going to take care of some of those now, and then we'll kind of come back to some of them when we come back to do the rental property. Okay, so first one we have on 199, she's got some gambling winnings. So we're going to go down. Well, let's take care of the bullet point on our way by here. She did itemize last year, filed a 1040. So we have that. And she had a refund of $342 that she will claim on there. Okay. Remember, gambling winnings, we go down to line 21. I bring up my menu, and I will go on to the sheet for the worksheet 7, as it's called within TaxWise. But I have my gambling winnings. I'll go up into my box, get my W-2G on there. Once I have that, get in the habit, taxpayer, check the address on the W-2G, and we look good there. That's on Pinewood Avenue. We have our gambling winners, our lottery for where she had her winnings from. Okay, so we have that in there. And she won $659, and we see it was on March 10th of the current tax year. Okay, now, no withholding. Sometimes people have withholding on their winnings. But the other thing the bullet point says is that we have $1,000 of losses. Remember, down at the bottom, we can put in there that gambling losses to be transferred to Schedule A. Well, it says she has $1,000 in losses, but we can only take losses up to and equal to our winnings. So in this case, when we enter down here at the bottom, we're going to enter 659 because we can't take any more than her winnings, even though she had $1,000 in losses. Okay. All right. We'll clean up her health care that we're going to talk about next. But she had health care for the entire year. So again, we'll talk about more of these boxes in the next chapter, but we're going to take care of that. The next little statement she has on here, she has some interest income. Remember that we do interest income on our Schedule B. We can find that on line 8A. Go in there, hit our F9, bring up our Schedule B. When we get into that Schedule B, nothing goes directly on the B. We're going to go down and light up the little B box, the 1B there, hit F9, and bring up our little worksheet that we have to put in the interest received. Okay, so we have that. All right. So once I'm in there, I see that she had from First National, she had regular interest income of $411.11. And then I like to break them out on a document where she had First National and she had some bond income. All right. And as you see in box 3, 1321. And then we know when it's bond activity like that, that we have to make our state adjustment for New York so that it is non-taxable on the New York side. Okay. All right. On page 200 in the workbook, she has a W-2. Okay. So we're going to go to that W-2. Again, check the taxpayer. Make sure that the address meets what we need to see on there. We'll enter the employee ID number for her job. Okay. And she's working for Gina's Hair Care Supplies as a hairdresser. We can see on there that she had $38,241 of income, and she had some federal tax withholding. Nothing in our box 14 here, so we can take that out. Make sure you always make note of box 13 and check that box for retirement plan. If something were to come about for IRA contributions or an 8880, we need to make sure that we understand that that's in there, that she is under a covered plan. There may be some limitations or some penalties there if it comes into where she's contributing and she shouldn't be able to. And we're going to put our state withholding. Okay. So we have those on there. All right. I'm going to have you set aside for right now the mortgage interest part of that. And we'll kind of come back to it. And we're going to also talk about our miscellaneous income there that we have on the page 201 with our rental. Okay. So we pretty much got everything else that she has on there that's in her bullet points and such. So now we're going to go do her rental. Okay. So let me just clean up the B here. She is not doing any foreign trust or anything like that. Okay. Now, as we talked about, line 17 has the rental real estate, royalties, partnerships, S-corps, everything like that. So I'm going to go to my line 17. I'm going to use my F9. I'm going to get in there, and the Schedule E has two sides to it. This case, we're doing the rental and royalty income side to it. Okay. If you look at page 2 of a Schedule E, and I'm going to do that very quickly, kind of what we talked about in the last chapter where it said things about the partnerships and S-corps. Well, this is where you would report that, is on page 2 of a Schedule E. You can see again where we have the little reference to the K1s. Okay, so you just make sure that you get your K1s in there. So you use your K1 worksheets. When you go into that, it'll give you the opportunity to bring up a K1, and basically that has been created from a partnership return. And when you get in there, you'll basically see what looks like the K1 that you have come over there. And you just make sure that things work together. The P and the S are for partnership or S-corp. And then you have to make sure that some of these things will carry over for you. Some of these things will have to be manually entered. Okay. That's part of the advanced class. We don't see a lot of K1s. You may see a few. But when you do an advanced class where we talk about 1065s and 1120s with partnerships and S-corps and those things coming over, even things from an estate or trust. If you look at the Schedule E and we go down a little farther, you can see Part 3 has income from estates and trust. So if somebody has a relative or a family member that passed and there's an estate and the money goes into the estate to be divided among beneficiaries, they may get a K1 based on what comes out of that. But again, something that we would talk about in an upper level class. Okay. All right. So we are on our Schedule E. Okay. This is page 1 of the Schedule E. This is where we're going to show the rental properties. Okay. As we come down here, you can see that there is a section that we have to list the properties differently. Everything's kind of coordinated by letters A, B, and C. So that we can put those in there. Don't enter anything here, as it says, if type 8, other, then we have to put the description. What we're going to do is we're going to put it in here, okay? Now, this is one procedural thing that I am going to show you, okay? If you go in there to the property, there is a worksheet that says Rental A Worksheet. Do not use that, okay? Do not. Put everything right on a Schedule E and calculate the math if it's a part year or duplex where you're splitting things. Do not use the Rental A. It creates a lot of havoc for the upcoming years and things that you would do. So make sure you do not use that Rental A worksheet, okay? So we have the property. It is the property she is living at. So we're going to put in the 65 Pinewood Avenue. All right, and I'm going to say this is Amherst. Okay. For the type, if we look back up here, we have our little table up above where we have our type, and it says the codes for the type of property. Was it a single family, multifamily, vacation, commercial, land, royalties? Again, royalties would show up if we have something that comes over from a K1. You can see a little farther up there that those things would carry over for that, and we would make sure that that type is a 6. All right, so we have those there. All right, so we are knowing that she lives in a duplex because it says in our one bullet point that Nancy lives in half the house. So this would be considered a multifamily. Okay, so when we're in here, I'm going to put a 2. It was available for rent all year long. Okay, as you can see now, we have the A here, and it corresponds to down below our income property in column A. So each one of these schedulees can have up to 3 properties. Obviously, if somebody owns more than 3 properties, we have to do more than one schedulee. I have one client that has 39 rental properties. So when you look on that tree on the left, it's a lot of rental properties, a lot of schedulees, okay? A lot of different depreciation. But we can only put each rental property, 3 rental properties, but each one has to have its own column on that, okay? Now, rents received. In this case, this must be something that she has set up to rent the other half through the city rental authority. There are times that you will get a 1099 miscellaneous like this from a rental authority because it's a rent subsidized, okay? So in this case, we're going to go in there. We're going to hit F9, and we can see that there's a 1099 miscellaneous in there, and we're going to open that up. From the taxpayer, we have the EIN number for the city rental authority. Okay. All right. Oop, that one came up as Donuts Unlimited. We need to put this in there as City Rental Authority. Okay. And that is on 344 Lincoln Avenue. All right. Okay. So we have that. And then box 1 shows her rent received, 8. Okay, so that is where her rent is coming from. If you see up here at the top, it says if Schedule E comes, select parent property. When we do this, we have a little pull-down menu. Okay, each Schedule E, there again, shows our A, B, and C, and it shows 65 Pinewood Avenue, but there's that little number 2 in front of it. That's the property type. That's our multifamily. So we're going to select that so that we make sure that we attach it to the right rental property for our income. Okay, so we have that in there. All right. Okay, so we have our rental and we have our rental income in there. So we're going to go back to our Schedule E page 1. As soon as we show that we are active in rentals, it's going to ask us, are we given any 1099s? Do we hire somebody that's maybe going to be doing snow and things like that we're going to pay more than $600? We should be giving them a 1099. So, but we're going to say no for this example. Okay. All right. So we have our rental income in there. We're going to go back to our bullet points, and we're going to see what all is entailed with this. And again, I don't want you to forget about that mortgage interest statement either. Okay. So Nancy has rental property that she owns. Nancy lives in one half of the house. Nancy bought the house on April 4th, 2006 for $135,000. Land value, $13,500. Sounds like something we're going to depreciate. Okay. We do have to calculate prior years of depreciation on the house. All right. Below is a list of expenses that she brought with her. She has receipts for everything listed. She rented the property the entire year. And she materially participated in the rental of the property. Okay, so she's doing it for profit. All right, so first thing we're going to do is we're going to go back and kind of clean up that 1098 on page 200 in the workbook. It's a mortgage interest statement. Well, seeing that Nancy lives in half the house, half of it can be personal and half of it will be for the rental. Okay, so the first thing we're going to do, since we know she itemized last year, is we're going to go to the Schedule A for her personal side. Okay? On that, we can remember that the real estate taxes on our personal residence. So on our 1098, it shows the taxes of $5,100. Well, she gets to take half of the $5,100 on her personal side. Okay? Same thing with the mortgage interest that's on the 1098 there. She gets to take half of that on her personal side. Okay? So we have those on the Schedule A. All right? Now, back to the rental for the 1098. It does have one other piece of information on there. It shows the homeowner's insurance. A lot of times in escrow, your homeowner's insurance will be paid out of the escrow, but she cannot take the homeowner's insurance for her personal side. But as you can see here on the Schedule E, we can take the homeowner's insurance for the rental side. So we're going to take the $700 that she has there, and she will take half of it there. Okay? As I talk about mortgage interest, she had mortgage interest paid to the banks of $11,500. So she's going to have half that, and she's going to have the other half of the taxes that comes over from the personal side, but that she can take on her taxes. Okay? All right? So we have those in there. Okay? So we've kind of cleaned up our 1098. All right? Now, let's talk about how to handle the expenses and the different things that are left for her rental property. Okay? If we look at the expenses, we had repairs to the roof. Well, if it's a repair, we can put it under repairs here on line 14. But if it's to the roof, we have to realize that it is a shared property. So we can only take half of the $89 of $45 for her on the roof. Advertising, obviously I hope that she's not advertising her personal residence, but if she was advertising anything for maybe rental of the property, if it was vacant, she could take the advertising as a whole. Next thing down says legal fees for the rental. And again, in parentheses, those were things for the rental. Okay, maybe she had to go to court to get the tenant to pay the rent. Okay, user fee, garbage and water. Okay, I'm going to show you a way to do this one. I realize we have a column for utilities, but we're going to kind of use this because I want to make sure that you're aware of this. If we go down to other, we hit F9, and other expense, a nice little worksheet comes up. And it's a great worksheet for this. It's kind of like some of the other ones we've seen for worksheets. It has properties A, B, and C. Well, if I'm a landlord of multiple units, I know that I'm probably going to have user fees for other properties, and I'm going to have water bills for other properties. Okay? It allows me to kind of divide them up, but just have one header there, and I can keep track of things. User fee, or garbage, for the entire property for the year was $600. But again, it's a shared property. We only get half of it. Okay? Same thing for the water. $750 per year. Okay? So we have that. We're the $750, and we have to divide it by 2. Okay? So we'll head back to our tree and head back to page 1 of our Schedule E. All right? And as you can see, got our user fee in there under others, so it shows the total other expenses. It did bring over the water fee also. Okay? Now, we are down to her depreciable parts of her rental. First thing we're going to talk about is Nancy has the rental property that she owns, and she bought the house. So we're going to go to depreciation, line 18. We are going to bring up a 4562 for depreciation. All right. Here's our depreciation. Looks very much the same as what we saw in the self-employment side of it. Our business activity or rental that activity which this relates to. When you have a 4562, I want to make sure that there's only one 4562 for each rental property. So in this case, I'm going to name this one 65 Pinewood. Oops, excuse me. Pinewood Avenue, okay? That way I know everything that is on this 4562 relates to that address, okay? Description of property, I'm going to go in there. As we said, for accurate computation, F9 to worksheet, you know, doing taxes, when I see the words accurate computation, I definitely think that's something that I want to partake in. So I'm going to go in there and I am going to get my asset worksheet. Okay, so we're on that business asset worksheet. Okay, so once we're in there, we have our property. And again, for the main building, I'm just going to use the address. Okay, that's the way I know that that's what that's for. All right, my asset type, I'm going to go in there, pull my little menu down, and if we scroll down, we have real property, residential rental. So I'm going to select that. Okay, my year in service, she bought it on April 4th of 2006. Okay, and again, once I go to, if it's a rental, I get that nice little pull down menu and I get to pick the rental property that it goes to. Is it residential rental? We're going to put yes here. And then we get down here and we start to look at what we're going to do with our depreciation. Okay, all right. Once we put that in there as residential rental, we have it in there. Okay, we're going to look at our cost basis. She bought it for $135,000. Okay. The next thing down is that we have land value. You cannot depreciate land. So if it doesn't have the land value listed, typically the rule of thumb is 10%, and that's what this is, $13,500. Okay. So as you can see right here, we have, it shows our basis for depreciation, okay, but it also shows 100%, okay? So we are going to have to know right here for business use, we're going to put in there that it's 50% because she only gets to depreciate half of it. So you can see now our basis for depreciation has changed to half the property. The other thing that is lit up is convention. We know for rental real estate, always going to be mid-month. Okay, so we have that in there. All right. Now, the other thing that you see that is red there is prior depreciation. And as it says here, calculate the prior depreciation on the house. Okay, well, we're going to have to kind of go back to a reference. We're going to have to use our table that we had in our book. All right, so give me just a second here. So we are going to start with the basis for depreciation. If you want to remember the number, let's grab a piece of paper here. And we'll kind of work through this together best we can. Okay, wish I had a dry erase board that I could write on the computer. But our basis is $60,750. And that is from when we bought it in April 4th of 2006. Okay, so 2006 is our first year of depreciation. All right, we have to calculate prior depreciation. So for the tax year 2006, 2007, 2008, 2009, 2010, 2011, 2012, 2013, 2014, and tax year 2015. So basically we have 10 years or 10 tax returns or whatever you want to refer to them as of depreciation that we have to calculate. Okay, so let me get this up here. So give me 1 second. So if we go back to our workbook, all right, remember I said we'd kind of come back to this. We were going to talk about depreciation. All right, we're going to use our little table here on page 1510. That's table A6 because we have a residential rental property, mid-month convention, straight line. So we're going to have to use our percentages. All right, 2006 was year one. It was bought in April. Okay, so if we take a look here, we have the month. Okay, the column on the left shows the year. Across the top says month of property placed in service. So we take a look here. Here's our column that we're going to use. Okay, so in year 1, okay, 2006, we get to depreciate 2.576%. Years 2 through 9, we're going to use 3.636%. Okay, and the last year, year 10, we're going to use 3.637%. Okay, all right, so that's where we're going to get to calculate our prior year's depreciation. All right, so if we take a look at that and we do our math here, okay, if you have your calculator, well, some people I guess just use the phone. All right, we have the $60,750 for the first year times the 2.576, percent. Okay, that first year we have depreciation of $1,564.92. Okay, the next year, all right. Okay, we're going to have our $60,750. We're going to have that times the 3.63%. All right. And that gives us in year 2, 2208. And again, we're using the same percentage on years 2, 3, 4, 5, 6, 7, 8, 9. Okay. All right. And then the last year, we're going to have that depreciation amount using the 3.637%. So 2209, we'll call it 48. Okay. So for total, we should have $21,445.36. Okay, so that would be our prior depreciation. Okay, so we have back this. All right, let's see here. Give me 1 second. Okay, so we have it here. And the prior depreciation, we're going to put in $21,445.36. Okay, so rounds it in the software to 21,004. Okay, so now we have prior depreciation. Okay, all right, Chris, we'll talk about that later. Okay, so I will catch up with you on that one. Okay. This is where, like I said, I was going to talk to you when somebody had a question about sale of the property. Okay, so if I decided now to sell that property, if I go back up to my worksheet, and at the top you can see there's 3 little gray boxes. At the right, I have the sale of the property. Okay, in the middle, I have a section where I'm going to sell my depreciable asset. Say that I decided to sell that today. Okay, so I'm going to sell that. Well, I'm going to say in 2016. I'm sorry, can't do it today because we're not in that tax year. And if I do that, now you can see that it filled in all of my property. Okay, and she sold that house that she bought for $135,000. She sold it for $150,000. Okay, but we have to remember that she only has to recapture or that on half of it. If it was her primary residence 2 of the last 5 years, the other half is tax-free. But this is the side that we have to look. So she had $75,000 that she sold the house for. Okay. You can see here that the basis for adjustment on the land, okay, and we have our depreciation. So that is the depreciation. Basically what happens when you sell a rental property is that you have to recapture the depreciation. In other words, you have to pay it back. The IRS has said, you know what, in that time that you had this as a rental, you had $23,562 of tax-free money that you are allowed to use, and now it's time to pay tax on it, okay? So we have to recapture the depreciation. So that adjusts our basis down to $43,938. When we subtract that from our $75,000 selling price, we have a capital gain of $31,062. So if you take a look at the little refund monitor in the top left box, she owes some money because she has to pay capital gains on the sale of that income property, okay? So that's how you handle that for the sale, all right? We'll take this out of here. When you do the problems, if you want to play with those a little bit, kind of see what happens with them, it's always kind of interesting if somebody sells it for a loss, okay? But people forget very often when they go to sell a rental property that they have to recapture that depreciation, okay? You can try, I had a question about the land value. You can try to find the land value if you want to. Sometimes deeds or assessments will have that. A lot of times they don't. They don't separate it out. So that, you know, the property or the assessed value or whatever you want to do for that is typically the house and the land together. It's not broken out. And that's why I say we use that rule of thumb of 10%. Okay? All right, so we have our house in there. Okay? All right. Now, if we go back to our bullet points, we take a look. She had a couple other things. She bought a new stove for the tenants, and she also did a bathroom remodel for the tenants. Guess a very nice bathroom, an $8,678 bathroom. I hope she has that nice a bathroom in her house, but she did that for the tenants. I would guess that probably includes a very nice bathroom with a jacuzzi, steam room, that, you know, depending on who she paid to do it. But we're going to have some more depreciable assets, okay? We need to make sure we keep the assets together under our 4562. If you take a look at the tree on the left, again, I refer to the tree quite often, but I look over here, I got my little cluster for my Pinewood Avenue 4562, and I have my asset worksheet that I'm on right now, okay? So when we have that, what I like to do is if I'm in there and I have other things, I'm going to go up to the tab at the top. You see these three little white tabs above the asset worksheet? It says Copy Asset Worksheet. Okay? As soon as I do that, puts another asset worksheet right under my 4562. Now I can go into my description. I can put in there for a stove. Okay? I have, you see here, appliances for rentals. She bought that in August 4th, 2016. It goes to this rental property. All right. And residential rental. We have an $800 stove. And again, 100% on this one because why? It was for the tenants. Okay. So you can see that we have our $800. We have 5 years, as we talked about from our table in the text, half year because of when it was bought. All right, so we have current depreciation and next year's depreciation. I don't have to do any prior because it was bought this year. We do have the option of this, of special depreciation, but we're not going to do that, so we're going to say no. All right, so we have that, and again, because it's a rental, we have no Section 179. So now we have our stove in there, okay? Same thing's going to happen for our bathroom remodel. We're going to copy the asset worksheet. We have a bathroom remodel, okay? Because that is for a leasehold improvement, residential, we put that in there. We had it completed August 16th, 2016, put in service. Again, little menu comes down. It is for a residential rental. She had, again, very nice bathroom put in, $8,678, okay? It is strictly for the tenants, so we have 100%. You can see that recovery period. It goes to the 27.5 because it is part of the structure, just like the building itself, mid-month. And we have our current year's depreciation, okay? So we have that, we took that in there. All right, so we have that. Now, if we go back to our Schedule E, all right, we can see that we've put in all of our expenses. We have our depreciation added together, okay? Now, obviously, with all the expenses of $12,000, we have a loss, and we go over to line 17. Whoops, excuse me. We go over to line 17, and we take a look. It's not there, okay? It should be a loss that shows over there. So we're going to go back to our Schedule E, and this is where we're going to talk about the bottom a little bit here, okay? If we take a look, we had a loss on that. And what we get to do, this is a little worksheet, at-risk limitation and rental activities. Did you actively participate in the rental activity during 2016? We're going to check yes, okay? And as you can see, it shows that we are allowed to take the full loss. So it calculates that for you, okay? Again, you know, we talk about things where, you know, that may be a limitation on that, depending on other income and such. This is where that would calculate that, okay? In this case, we have our $3,462 loss, all right? And when we go over to our Schedule A, we can see there it is, okay? So we have that on there, all right? So we have everything in on our rental. The nice thing about it, she's kind of got a nice little break-even year, so that her refund from the federal, 181, and the state balance due of 143, okay? So those are the way the rentals are handled, all right? Again, you know, if we had a royalty there, you can see that you would do it, put a 6 in the type, have the royalties received, and that would go in there for you. A lot of times we see royalties now because they come over from a partnership or some type of ownership within a K1, so that would come over on that. Okay. Any questions? Oh, we got one come up here. Yes, the other half of the mortgage interest and the property taxes I put on the Schedule A because they were for her personal residence. Just as I said, when she sold it, she only has to worry about recapturing half, okay, because she's doing that depreciation on half, okay? Like I said, that's one of those things when people go to sell rental properties that they kind of forget about is the recapture, okay? It's a tough one. That's where the you see and hear advertised. We have one that advertises on our radio show with Esther on Saturdays from 3 to 4. That is a 1031 exchange specialist. 1031 exchange is where somebody will take a rental property or an income property, sell it, and it goes into a 1031 exchange because they're going to do something with it on the other side that would allow it to avoid capital gains, okay? So, you know, that's a option. You have to do a like-kind exchange in that method. So when it comes out the other side and that proceeds from the sale of that rental, when you use it, there's a lot of restrictions or stipulations that would require what you do with that income. But that is a way to avoid capital gains on the sale of rental properties, especially when you have to pay that recapture. Okay. All right. Any other questions? Okay. All right. So we're going to take another 5 minutes. Okay. So we have that, but we'll take 5 minutes here. We'll come back and we'll do healthcare, which I'm sure everybody is very, very excited about. So I will see everybody. Okay, welcome back, everybody. This is really our last chapter that has real strong content. Like I said, next week we're going to do chapters 17 and 18. We'll talk briefly about other taxes, about amendments, and a little bit about your ethic in practicing before the IRS. There's not really any homework or problems or stuff, but we're going to talk about healthcare. As I may have said at the outset of the lecture, but I'll remind everybody, I am not only a tax preparer for EG Tax, but I am also what's considered a healthcare consultant. I do as a navigator for the marketplace for those under 65 through the New York State Marketplace for the Affordable Care Act that we're going to talk about. And I also do insurance Medicare for those over 65 as a broker to enroll people that. So healthcare has become such a big component of not only the tax return, but when somebody's retired, it can be a huge component and cost of their retirement. So we felt like it was a good segue for us, so we've added that service to our EG Tax service. So if you ever have any questions about either one of those, please don't hesitate to reach out. Okay? All right. Healthcare. Following the passage of the Affordable Care Act, your tax return had to have a section to disclose whether you did or did not have health insurance, okay? So the Affordable Care Act says that every person has to have minimum essential coverage, or they qualify for a health care exemption that they don't have to have coverage. We're going to talk about that. Or if they don't have insurance, and again, minimum essential coverage could be through the marketplace, could be through an employer or some other things. But if they don't have that, you have to make what's called a shared responsibility payment. Really what it is, just as the Supreme Court of the United States said, it's a tax. They are going to tax you if you do not have a show that you had health coverage all 12 months of a year, unless you can qualify for an exemption or you have insurance that meets minimum essential coverage, okay? Again, the Affordable Care Act also brought into play what's called a premium tax credit. That means based on your household's income on a tax return, that you can qualify for a subsidy or credit to help you pay for your health insurance. That credit can be either as a lump sum credit, as the premium tax credit on your tax return, or it can be what's called an advanced premium tax credit, where you get an amount each month to help you pay your premium. And that goes to the insurance company, and then they bill you for the balance. That being said, that is only available to those that go through the marketplace. You cannot get the credit if you have employer-based insurance, or you cannot get the credit if you go directly to an insurance company and pay for insurance. You must be enrolled in these marketplaces, whether it be a state one, like New York has, or some states, it's run by the federal government, okay? So we're going to talk about all the things with healthcare coverage, all right? As far as the shared responsibility provision, all right? Again, very soft words. You're sharing the responsibility, okay? It is a tax, okay? You must have qualifying health coverage that meets minimum essential coverage. There's a table on the next page that talks about what those are and what classify for them. Basically what it is minimum essential coverage is it has to cover hospitalization. It must meet that. Now, in order to be other plans that meet all these coverages things, there are components of insurance that must now be offered as the base insurance for insurance companies. That is different than the minimum essential coverage to meet the shared responsibility. Again, we could have the option that we have an exemption that we're going to talk about, or you can just flat out pay the tax. And this year, $695 or 2.5% to the modified adjusted gross income, whichever is greater, okay? So I have seen penalties to $3,000, okay? So not having insurance, there is a tax, and that tax comes in and can take part of your refund, okay? However, if you would like not to pay that tax, we can fill out the Form 8965 to have an exemption from the shared responsibility penalty, okay? And again, we're going to talk about that, okay? Now, when we talk about health insurance, we are talking about your tax family or your tax household, okay? It's not necessarily who lives under the roof. So, on your tax return, mom and dad that live with you may not be on your tax return. Or if you have your brother that you live with. Your responsibility is strictly for your tax household, those individuals in your tax family on your tax return, okay? So just remember that. Even when you apply for insurance through the marketplace, it is based on your tax household, all right? We talked about the minimum essential coverage. Now, health coverage exemptions. We talk about this Form 8965. We're going to see it in action when we do a problem. But what this form has is 3 parts. Part 1, you can get a grant of an exemption from the marketplace. Basically, that grant is a hardship. You complete a form that has a hardship, okay? And give me 1 second. I'm going to kind of show you those. So give me 1 second. I will be right back. Okay. Okay. So these are the exemptions. This is part 1 of the 8965. Okay. So you can put this on a form. There's a form that you fill out, you mail in. It goes to a place in Kentucky for the IRS. A hardship could be you were homeless, you were facing eviction or foreclosure. For those of you that don't have health insurance, you could decide, maybe I'll let the lights be turned off. I'll stop paying my utility. So if you have a shut-off notice, you could claim a hardship, and you could be part of an exemption. You experience domestic violence, the death of a family member. Right now, the fires in California, somebody that's experiencing a hardship from that, that's a way that if they do not have health insurance and do not want to pay the shared responsibility, they could do that. You filed for bankruptcy. This is kind of an odd one, but medical expenses you could not pay, okay? So if you don't have insurance and you end up racking up medical bills, you don't have to pay the penalty, okay? Probably still a good idea to get insurance. You experience increases in necessary expenses due to caring for an ill family member, okay? All right, so we have that. Again, claim a child that is dependent that was denied coverage for Medicaid or CHIP. You appealed your decision in the marketplace. You determined ineligible for Medicaid because your state did not expand. New York is a state that went and expanded. The threshold is based on the poverty level. The national threshold for Medicaid is 100%. But in New York, if you're at 138%, you still qualify for Medicaid. That is the expansion. Your grandfathered insurance plan that you've had since March 23rd, 2010 was canceled because it didn't meet the care. That's a hardship. And the last one, you had another hardship. So basically, if none of 1 through 13 apply, you can make one up, put it on the form, explain why you feel it is a hardship, and submit it. So that's the miscellaneous category, okay? So that, when we talk about the 8965, and we talk about the hardships, that is what we're referring to. Okay, that's granted by the marketplace on a form. The second one down is based on your return for your household. That means, did you meet the filing threshold? If your tax return based on your household on the tax return, again, your tax family, is below the filing threshold for your income, obviously you don't have to file a return, but the other thing is you don't have to pay the minimum essential, or the shared responsibility penalty. Okay, so that being said, if you're below the filing threshold, really you could afford insurance because chances are you're going to be on Medicaid, the free insurance. Okay, the last one, these are where you do this based on the individual. So if we take a look at our little table here on the next page, you can see this column to the right that has codes. So for part 3 of the 8965, we're going to use the codes that are here. Okay, at the left, it describes what those codes are. All right, now the most often one that we use are A's and B's. Okay, if the insurance is considered to be more than 8.13% of your household's income, then it is unaffordable. Okay, if you have a gap of 3 months or less, then you can do an exemption for those 3 months. Okay, goes through several other ones that talks about you're a member of a healthcare sharing ministry. Those sometimes you hear on the radio. Those are the co-ops where everybody, like the old union model, pools their money together. When they have a claim, they go to the treasurer of the co-op and say, I have a bill, and they give them the money to pay it. Okay, so that's where that is. When you do those healthcare sharing, a lot of those are very restrictive, and typically they're only going to, again, cover the major medical because that's the minimum essential coverage. They're not going to cover your day-to-day, senior primary, senior specialist, your prescriptions. That's something that you'd have to do on your own, but the healthcare sharing ministries will do that as far as major medical events. Okay, and you can see there's several other ones that go down through there that talk about the different exemptions. That would be part 3 of our exemption form, or 8965. We will see that when we get into the problem that we're going to work on. Okay, all right. Household income. The one thing you have to remember with household's income is that it is a modified adjusted gross income. What that means, it's not just the AGI that we see on line 37 at the bottom of page 1 of our 1040. We must do the modified. If there's somebody on the return that has Social Security, we take the gross amount, not the taxable amount. Okay? The other thing is, if we have dependents that are required to file a tax return, we must add their income to make the modified adjusted. So when you apply in the marketplace, you're using everybody's income that is on the tax household and using that income to calculate what you would be eligible for insurance. Okay? All right. Here's, again, figuring the shared responsibility. We talked about it. $695, 2.5%. Okay? Can be a lot of money. All right, so that's that. As far as somebody coming to you and saying, do they have health insurance? They would have one of 3 forms of the 1095. They would have one from the marketplace. We're going to see this one in action when we do the problem, because the one from the marketplace will show that advanced premium tax credit that they received, and if they used it during the months, we have to reconcile it on the tax return. The B's and C's come from either Medicaid, Medicare, the employer. It's basically a statement that shows who was covered and how many months they were covered. When we first did the forms for the tax returns with the Affordable Care Act, there was no way for us to put on the return. We just had to check if they had insurance. So somebody could come in with an insurance card and say, here, I have insurance. Well, for any of those of you that look at your insurance card, it doesn't say what months you were covered. It may say when the insurance started or when the insurance expires, but it doesn't say how many months during the year that you had it. We used a form in our waiting room to have people fill out. to tell us what months so that we were able to determine if they had all 12 months. But, you know, this now is a form that we see, so we can say, I see you had it from an employer plan, but it didn't start till March. And that's not uncommon. If you think about a new job, sometimes you're on a probationary period, and that's where that short term, that 90-day gap may come in because you're on probation before your benefits start. Okay? But those are the forms that you would see there. Here's our 8965. We'll talk about, when we get into it, the part one, where the marketplace, where we talked about the hardships and the form that goes in. Oddly enough, there's a spot that if you have not received your certificate number from the marketplace saying what your exemption is, then you can use those, okay? You can use those parts of that to be able to just put in the letters pending. And believe it or not, the number of letters in pending is the same number of numbers that are in the exemption certificate number, okay? You see part two talks about your filing threshold, and part three, again, when we do the practice problem, that's where we would use the letters that we saw on the table for the exemption, okay? So that's your Form 8965, okay? All right, now, the premium tax credit, okay? This is a credit that if you go into the marketplace and your income is above the level for Medicaid, that it would determine to say that you are going to get this amount of assistance to help you pay for your health insurance through the marketplace. Again, only through the marketplace. This does not apply to anybody that has employer-based plans or anybody that paid directly to an insurance company and did not go through the marketplace. The premium tax credit is based off the second lowest cost silver, and the advanced premium tax credit, again, that is when you take it prior to the end of the year, okay? The premium tax credit is basically reconciled on your tax return. The advanced, that is the money that is sent monthly to the insurance company that you choose to lower your premium so that you pay less for your insurance and you get the coverage that you want, okay? All right. And again, more of this we're going to see when we get into the practice problems. I'll explain a little bit more of it with all the calculations. A little table here. Again, it talks about the premium tax credit. For a family of one, poverty level, $11,770. You're below that, you're on Medicaid. You can get a premium tax credit as an individual up to $47,000. So if you look there, family of four, mom and dad, 2 kids. If their income is less, and again, modified adjusted gross income is less than $97,000, they are going to get a subsidy or credit to help pay for their health insurance, okay? So that's where we have that. 1095A that you see here, like I said, is different. You can see the boxes at the bottom. When we get the coverage for 1095A, and this is kind of where we're going to be doing our problems to be able to see these, we have a monthly enrollment premium. That's what the premium would cost us if we paid full price. All right. We have our second lowest cost silver, and then what we get each month. Okay. Yeah, this is a little bit why people are worried. Can the Affordable Care Act be repealed without having something in place? No. When you have 10 million plus people that are counting on this system that's been put in place to pull the rug out right now, 2 things. What are you going to do with these people that are in care or coverage because they now have health insurance? And 2, the impact of pulling it out on the industry that is 1/6 of our economy being healthcare. What would the impact be on that if they do not have insurance and no way to pay all these bills that is a part of a 1/6 of a part of our economy? That's why repeal and replace has to be. You have to replace it with something. Can you totally overhaul it and change it? No. It's in place. It's part of it's intertwined into our society. Does it need to be tweaked? Yes, definitely. Okay? That just does not work well. And the fact that you are restricted by county is just not fair. Okay? Prime example on this, My mother lives in Iowa, and I was out to visit her over the summer, and I was reading articles about the healthcare out there. They have 99 counties in the state of Iowa. There are 26 counties that have no marketplace insurance plans. So if you're required to buy insurance, you do not have any place that you can buy insurance from through the marketplace to get a subsidy credit. Out there, your only option is to go to the insurance company and pay full price of somebody that you know. So they're restricted by county, and some of the counties have no options. We here in Erie County have about 8 or 9 options, but again, we're in a more densely populated area, okay? What needs to happen? Editorial for me is that just as President Trump has done with the associations, allowing them to go across state lines, we need to regionalize it. For us to be restricted, even the difference, what is offered between Erie and Niagara County here in Western New York is different. There's a lot less choices in Niagara than there is in Erie. Again, less populated area. What needs to do is it needs to be regionalized. Prime example, Western New York, over towards Rochester, down towards Erie, PA, all very similar cost of living index. If we had them as one region, there would be 12 to 15 companies vying for the business in the marketplace, creating competition. When you do it by county, there's no competition right now, okay? So that was my soapbox editorial, but I'll get into that more later, all right? So we have our 1095A, all right? So we have our monthly premiums. We got our subsidy and credit, all right? So we have that. We talked about the advanced premium tax credit that they get ahead of time. We have our 1095A again. We'll see that in action when we go into the return. Now, when we have the advanced premium tax credit, it is reconciled on a form called an 8962. You can see one here. Again, when we do the problems, we'll talk a little bit more about each of the sections. But this is where when you have a premium tax credit that is being reconciled through the marketplace, you're required to take and do this form on your return. And we'll see how that's initiated when we do the tax return. Okay? All right. And we are good. So we've covered all the topics. Now what I'm going to do is cover the rest here by going into our tax return. Okay? So what I'm going to use is I am going to use, okay, hold on one second here. I am going to use the returns as you see there. If you go into 215, chapter 16 on your workbook, we're going to use the grays. This is somebody from an earlier problem that we had, and we're going to talk about it. Now, the grays had tax insurance. The first problem, we go to their ACA worksheet, or the worksheet that you have to determine what they had. They were not in the marketplace. They had insurance all 12 months, so they did not need exemptions. So our first 2 boxes here are no and no. And basically, you know, I've kind of just gone through and checked the first box and told you we'll talk about it later, we'll talk about it later. Now's the time to talk about it, okay? So when I have these boxes here, and these are the boxes after each name, I have these little boxes, all right? The first box says had minimum essential coverage and or is applying for a grant for an exemption. Basically what the first box is saying is I have accounted for all 12 months in determining when they had health insurance. If it's the case that the first 9 months were through an employer plan and they lost it and then got a new job beginning January the next year, I have 3 months. I have a short-term gap, okay? The second one is saying that they had minimum essential coverage or is applying or was granted an exemption for part of the year, okay? So that is basically saying I'm going to check that box, and then I'm going to check the months down below when they did not have coverage and did not have an exemption. Again, we're going to talk about that when we do the problem, one of the other problems here, okay? And the last one's basically saying that's that individual that comes in, you say to them, well, did you have health insurance? They say no. Well, can we try an exemption? No, I don't want exemption. I'll just pay the penalty. I don't like this insurance thing. That's the individual. You just kind of have to go with it and say, okay, fine, here's your penalty. All right, so we have that. So in this case, on the first one, probably an employer-based plan. They had insurance all year long, no exemptions. Kids were covered by Child Health Plus or whatever it may be. So we're all set, okay? Now, if we go to take a look at the problem on 215, this is problem 16.2 for Michael and Laurie Gray, okay? So we have everything that's there, but now the family had health insurance the entire year through the New York State marketplace, okay? So this is where, if we take a look at page 217 of our workbook, we have a 1095A. What we're going to do on this one, on our ACA worksheet, we're going to create and say, yes, they were in the marketplace. Once we do that, if we take a look on our tree on the left, we can see over here, it generated our 8962. Okay, so we have that form that has been created because we said yes on the marketplace. We see on there that it accounts for all 12 months. And as it says in our bullet, the kids were covered through Child Health Plus. If the kids or anybody on the return is through Child Health Plus, the Essential Plan, or Medicaid or Medicare, none of those have to be reconciled on the tax form, okay? Only those that are a bronze, silver, gold, platinum plan have to be reconciled with the premium tax credit on the tax return, okay? So we've done this. We've created that box to say yes. We have our 8962. Well, we're going to go to our 8962. We saw a picture of it in the textbook, and we have our 1095A. So here we have Michael and Laurie Gray. Family size 4. We have their income from the W-2 for Michael. And the next question says, enter total of your dependents' modified adjusted gross income. Again, in this case, we have, I believe, Jessica and Joshua that are on the return. If they had enough income that they're required to file, I have to put that modified adjusted gross income on the tax return, okay? But in this case, not any income we have to worry about. So we have our household income now. Again, tax household. Not adding anybody else that might live, just our tax household. Poverty line. Well, you have 3 choices. Obviously, Alaska and Hawaii are kind of outliers, but we're part of the 48 states. So as you can see, it gives us what our filing threshold, or excuse me, our poverty level would be for our household size, and it gives us our percentage. So on this, we have that we say that we're 239% of our federal poverty level. All right. Down here at the bottom, you can see that it says they would be required to pay $377 of the health insurance cost. That is their monthly contribution amount. Part 2, premium tax credit. And this is where we're going to reconcile it. Okay. The first one's asking, are you allocating parts because you got married? No. Okay. The one thing I will tell you about this, page 2 of the 8962 would be the situation where you have somebody that is one of the people getting married is in an employer-based plan, and they marry somebody that is in the marketplace. Once they get married in that year, the person that was in the marketplace can now come on to the other person's insurance and be covered through the employer. So they drop their marketplace. This is where you do a shared policy allocation. Now, I have learned to do this, and I do most all of them for everybody that does tax returns through a EG tax. They'll call me up and say, make sure you do this calculation. We had a letter come back for a couple that this was happened to. We had done the calculation, and it was questioning our amount that we claimed there to allow them not have to pay any type of premium tax credit back because they went from 2 separate returns, 2 separate incomes to combine, so it would throw that off. We did the calculation, turned in the form, and once we did the form, it was sent to the IRS. The IRS sent a letter. We sat down, we calculated, and sent our response. Once again, we came back, and we sent this letter in, and we had to call the IRS. Well, we got on the phone with what would be Affordable Care Act portion that handles this from the IRS. We were transferred a couple times. Our last transfer was somebody that was a Affordable Care Act premium tax credit specialist level 2. Well, you think they got promoted from level 1 to level 2. This is going to get us our answer to make sure that we did it correctly. Went round and round with the individual, just told them how we got our calculations, and at the point she goes, you know what? I've never done the calculations, and they've never taught us how to do the calculations here at the IRS. So basically they said, you must be right. Sounds like you know what you're talking about. And they just gave us the rest of their refund and said, we'll go on our way. Okay? So basically what I'm saying is the Affordable Care Act and the IRS don't mix very well. All right, another little editorial, sorry. Okay, next question on 10. Just skip all the top part. Don't worry about what it says up there, okay? Excuse me. Basically what we're saying here is that, oops, I had a question, hold on one second here. Line 2B. Yeah, that's where I said about line 2B. That's where you would enter the dependent's income if they were required to file, okay? Now, line 10, just kind of skip through here. Basically, your yes or no here that you're answering is you're answering yes if they had 1095A that showed all 12 months. You're answering no if they were only getting the premium tax credit for part of the year, okay? We look at our 1095 on 217, okay? All right. We have yes, and we can see here that we're then get lit up red for our calculation. Well, if we take a look at the squares here at the top, we have columns A through F, and on our 1095A on page 217 in the workbook, you have columns A, B, and C. Now, A and B make sense. If you read them, at the very bottom of it, it says Form 1095-A, line 33A, line 33B. Now, the tough thing is, over here, we have in column F, line 33C. So, we just basically have to fill in what comes off the 1095A. In this instance, A is $80,439.36. Column B, off of our 1095A, and we have column C goes under column F, so I guess in this case C equals F. We have that. So now you've put that in there. Now we have to determine, if we go down farther here, what does that mean for them? Well, as you can see here, they got their premium tax credit. They had a certain amount that they should have had. Now, they got an excess of $2,549. That means they would have to repay that. As Part 3 says here, this is a repayment of the excess credit that they received throughout the year, the advanced premium credit. Well, 28, you can see, based on their percentage, they would only have to pay back, okay, $1,500. So basically, they got $1,049 of free insurance because of their income level. Even though they did not qualify for this, even though they put in maybe incorrect income in their application in the marketplace, they still only have to pay back $1,500. Okay? Now, if I go back up to the top, I'm going to kind of show you this. All right? If I say that there was $10,000 from Joshua, he would have to file, so $10,000. You can see 281% of the federal poverty level. If I go back down to the bottom again, now they received $4,221 too much of a credit. But because of their percentage of the poverty level, they only have to pay back $1,500. This case, they got $2,700 of health insurance back for free. Okay? Now, if I put in here $15,000 from Joshua, had a great job at Tim Hortons over the year. You can see that they got to 301% of the federal poverty level. Now, if we go down here, $5,086, but because they're now above 300% of the poverty level, their repayment limitation is raised, and now they have to pay back $2,550. Okay? So, you can kind of see how this works. Is there loopholes? Is there problems? Yes, there is. You wonder why that there's the discussion about replacing this thing. Okay? Some of it just does not work out the way it should. Okay? So, we'll take that out of there. Okay, so we're back to where they were before. All right. Now, next problem we're going to go to is 16.3. And in this case, we have that they had insurance. If you look at the 1095A on 220 and look at the bullet point, they decided that they were going to stop paying for insurance. Okay, so we have 2 months that we must account for. So we're going to go back to the ACA worksheet and start there again. Yes, they were in the marketplace, but now we have it to need of an exemption. You see from the 1095A, they did not have insurance in November or December. So we're going to say yes here, okay? If we look at our tree on the left, we can see over there that we have now the 8962 and an 8965, our exemption form. So this is where we would have to take care of that. So 8962, we look at this. Again, I have all 12 months accounted for. I have the marketplace for 10, and I have an exemption for 2 months. So I can still check the first box after their name. All right? We're going to start with the 8965. We go to that. Again, part 1, if we were asking for a hardship, we would put in the name of the individuals and the exemption. Okay? In this case, this section is asking, what is the household income? Their filing threshold is $20,700. Obviously, from the ACA worksheet, their income is above that. So they will be paying, or excuse me, they cannot claim this exemption. Okay? So we have to say no. Part C, this is where the 2 individuals that are in the marketplace that have 2 months of non-coverage, we need to account for them. Okay? The kids were still covered under Child Health Plus, but for this one, we have Michael. We have Michael. All right, we have to put in his Social Security number. All right. Okay. And his exemption would be a B for short term. And what we do is the last 2 months, we're asking for an exemption. Okay? All right. Next one, we got Laurie. Put in her Social Security number. Again, short-term gap, last 2 months. Okay? That keeps them from paying the penalty. Okay? Now, we go back. We're on our 8962. We got to put our 1095A in. Again, no dependent income from Joshua or Jessica. We're at their poverty level. We've answered no here because they did not get married during the year. Now, this is where we have to switch our answer. We're going to put no here. Okay? We have to get rid of the things on line 11. And if you look, what lit up is the form down below. I have to enter by month. Okay? So I have my 703 in the first month, or column A, I should say, I'm sorry. I have my 590 in the next one, and I have that they received 280 in the third one. Okay? So I have that. Oops. Give me 1 second here. Okay, so we have to put those down in each one of those columns. Okay. Okay, so again, you see, $670 they need to pay back because they got too much. They have to pay that back. All right. So on that, we had that. Okay. All right. So that's the way the part year. Okay. Now, we're going to take this one a step farther. It's not in your book, but we're going to kind of talk about it. Okay. So we're going to go back to our ACA worksheet. Not only did we're going to say that they did not have insurance for the last 5 months of the year. Okay. Kids were covered by Child Health Plus, but mom and dad did not have it. Okay. We can still do a part year exemption. They're in the marketplace. But this is where that they had minimum essential coverage. Okay. All right. And now we're going to say, okay, we have the last 5 months of the year. I'm going to have 3 months for a short-term gap. Okay. But I'm going to have to pay a penalty for the last 2 months. So each of these, we'll check the second box and then check November, December. Okay. When we do our exemption, we're going to say that we're going to use these 3 months as our 3-month exemption. Okay. And on the 8962, I'm going to take out those months. Okay, so I'm going to say that they just kind of decided they didn't want to pay for the insurance anymore. They weren't using it for themselves. They kept the kids covered. Okay, so that's where they're there. So now you can see $469 too much they have to pay back. We go to the ACA worksheet, page 2. We see the calculation of their penalty at the bottom. 4 people. This is the income. And again, you have to add in for any dependent who's required to file the tax return that's there. Okay? So you can see on this, we have a calculation. They would have to pay a penalty of $232 for the months that they did not have insurance, those last 2 months. Okay? So you can see the combination there. Now, if you remember, we go up to the top left here on their return, they had a refund starting out of roughly $2,300. Okay? All of the things that we did with the healthcare was impacted by the healthcare law. So they lost roughly $700 of their federal. None of this has any impact on the state, none of this healthcare law. But at one point, because they did not have insurance and what they had to pay back, their refund dropped all the way to roughly about $800. Now, this is where the healthcare law that I struggle with the mandate and things like that, because I do have households of people that I do that they basically have their refund be the way they might pay their property tax after the first of the year. Well, if they're counting on that $2,300 refund, and because of what happened to them with health insurance, they come in to see me and I say, your refund's $800, they can't pay their property tax bill. Okay? So that's a shame that that's the way that the healthcare law impacts a person's return. But something has to be done. We can't just give away everything and have taxpayers pay for it. But you can see there are flaws in the system, but this is the way that it is reconciled on somebody's tax return. Okay? So that's the way the healthcare law works. Now, one other thing I'm going to show you, and this is just kind of a point of interest for you guys, is, believe it or not, the prices for 2018 health insurance have gone up 18 to 35%. Okay? And that being said, there are a couple things that that we have in here that we can talk about. Okay? All right. So, healthcare, 2017. I have an individual that needed to get health insurance, and their income is $35,000. Okay, so we have $35,000. They are going to get $119 a month to help pay for their health insurance. Okay, so their least expensive insurance, well, we're going to do silver because this is what everything's based off of. Hold on one second. Their silver plan, the first one's $261, the second one's $278. Okay, so we're going to remember those numbers. $261 for the base silver, and the second lowest cost silver is $278. Okay, if I change it to 2018 and I do the same individual, okay, just a single person, $35,000 of income, they're now getting a $250 subsidy or credit. That being because of the second lowest cost silver plan. As you can see here, the gap increased. So if that individual, even though this insurance went up by $100, they would actually pay less for it in 2018 because the second lowest cost silver plan has gone up so much. There's what that is. So the first plan on the silver last year cost that person $261. This year, it would only cost them $158, even though the premium went up. This is where I'm talking about. When you have it based on the county and you have prices where that big discrepancy happens between the first and the second plan in the silver, the second lowest cost silver, all of a sudden our subsidy and credits, that's tax dollars being used. That's where the price of the Affordable Care Act each year spirals out of control. Okay? Because now I can get that second plan actually for $7 cheaper, even though the plan increased by $200 on its base rate. Okay? So you can see how this works. All right? Minimum essential coverage, or excuse me, the essential plan, if you're a person, individual, making less than $24,120, you can get insurance in the New York State marketplace for $20 a month. Okay? And again, all these things, they're just kind of topics that are in there. All right? All right. So that wraps up for today. Okay? So I'm kind of sorry I got off on my editorial tangents with the marketplace, but just the nature of the beast that I deal with on a daily basis. Okay? One thing, for those individuals that are here live and anybody that watches the entire video, I'm going to give you a little clue about things that might be on the final exam. Okay? The final exam is basically going to cover W-2 income, and it's going to cover schedules A, B, C, D, and E. Okay? And we've done all those. A, itemized deductions. B, interest and dividends. C, self-employment. D, capital gains. And E, rental. So that's basically what you need to know. You need to know your W-2 income. You need to know those schedules. And believe it or not, the family that is doing the return, in case you know anybody with the last name Demick, D-E-M-I-C-K, I guess you could friend them on Facebook and ask them about the return if you want further insight. But Demicks are our family, and they do have a college student also. Okay? So, W-2 income, college student, and then schedules A through E. All right? Even though I grew up in farm country, I'm not going to make you do a Schedule F for a farm because I don't want you to have to do the whole depreciation on the cows and the pigs and all the other stuff. Okay? So that's what we have. All right? Again, for the final two, we're going to use next week. We're just going to talk briefly about some other odds and ends of taxes. Really, the only thing we're going to cover is the kiddie tax and talk about that. Talk about how to do amended returns. But again, make notes for next week so that you can decide what questions you may have before the final. This weekend, I'll send out the answers to the exercises and the problems from 13 and 14 so that you'll have those. And if anybody hasn't turned in their interest to work, please forward that to me if you have completed the midterm. Okay? All right. Any questions from anybody? Like I said, next weekend will be basically an open forum for everybody to sign in and ask questions about anything from along the tax year. Otherwise, stay warm. I know tomorrow's supposed to be a cold day in Buffalo, so get your Christmas shopping done today and put another log on the fire. Hope everybody's decorations are up, and we'll see everybody next Saturday.